Hi, I'm Pattu from freefincal. Today, let's talk about a question several readers and viewers had asked me over the past few days after the RBI announced its annual report and talked about the possibility of a stock market bubble. Should I stop investment since the RBI has declared this? Before I do that, a quick thank you to everybody who participated in the Q&A in the comment section of the video last published. There are quite a few comments. I have answered, I think, about 60 to 70% of them. There are some left. I will try to answer it in the next couple of days. I'm sorry, there's too many questions I did not answer. I expect so many questions, but I'll try to keep up. The YouTube interface is not very friendly to keep track of everything, but I'll do my best to answer the questions. Right, so this is now with respect to the annual report published on May 27th, 2020. Since then, there was news yesterday that the GDP has shrank by about 7.5%, whatever. And then you would notice that today the market did not react to it at all. The opening was not in red. It was pretty much a normal day in the stock market, and both these are related. And the reason why the market was not surprised at all, because they probably expected the GDP contraction to be worse. At the very least, everybody knew that the GDP growth is going to be affected because of the lockdown last year, and it's also going to be again affected because of the current lockdown. So on page 93 of this annual report, the RBI has a section called "Is the bubble in the stock markets rational?" Of course, bubbles are not rational. I don't know why they had to say it like that. In essence, what they said was there is an 8% contraction in the GDP, but there's a 100% increase in the stock market since the crash. These two are these two data points don't make any sense, and therefore it looks like a bubble. This is completely wrong, because we're just going to discuss this. There's really no way to have a one-to-one correspondence between the GDP movement and the stock market growth. And the RBI has actually admitted in the very next paragraph. In the first paragraph, they talk about the possibility of the risk of a bubble and so on. But they go on to say that the stock price index is mainly driven by money supply, foreign investments. Then and economic prospects also contribute, but the impact is relatively less. So I don't know why they have to say that there is a risk of a bubble, and then in the very next statement say that the economic data, the impact of economic data on the stock market is relatively less. It's really silly, because people, the press is always going to look at the bubble and not worry about what's written in the next paragraph, and that's what happened, and that's why people got scared. Now, everybody knows that because we have seen a 90-100% surge in the past few months, and already it has been slowing down since the start of this year. Obviously, between March 2021 and March 2022, you are not going to see a 90% increase. It's very unlikely to see that. The market will probably wait. Already, I think the market is basically waiting for corporate earnings to catch up, and we will have it's very, very probable that you're going to have a muted return. This is common sense. You don't need to be a genius to figure this out. But the point is that just because somebody has said there's going to be a bubble, and it doesn't mean the market is going to come crashing down. That doesn't work that way, because something unexpected should happen. And saying that the GDP has contracted is not an unexpected news. Everybody would know. It's just that the number would be different. That's all. Now, I want to point out that there's a wonderful video by Ben Felix, who's a portfolio manager. There's this channel, you can subscribe to it. It's a wonderful channel. He always talks in terms of data, and I respect that. He has a video called "The Stock Market versus the Economy," and he talks about a paper by Jay Ritter, which categorically proves that economic growth does not benefit stockholders. In fact, there's a negative correlation between the economic growth and stock market returns, both for developing countries as well as developed countries. And we had also seen this recently. I talked about how the 42-year return of Sensex and S&P 500 is the same, although the economies are very, very different, right? I mean, so there is really no correlation either in the short term or in the long term. There's no direct one-to-one correlation between the economy and the stock market returns. It simply doesn't work like that. There are too many other factors that drive the stock market: euphoria, fear, widespread fear that causes sharp downward movements, and so on. There are many forces that govern the stock market returns, and it just doesn't one-to-one correspond to GDP growth at all. So there's no reason to stop investing now. And that's the most important point I want to say. I've always said it, your life will change if you keep investing systematically during a sideways market or a period where there is a lull in returns. I believe that the next couple of years there is going to be poor returns in the stock market. There are not going to be any returns in my opinion. But this is the best time for you to invest. This is the time for you to systematically invest. If you have a lump sum, don't worry too much about it. Don't wait for the right time. There will never be a right time. There will always be a time you will get a loss. Every day you have to be ready for a loss. If you have a lump sum, if you're sitting on a lump sum, then just invest it a little by little every week and just get it done with over the next few months. Just don't wait, because time lost will never come back. Your life will change at a time when the market picks up. At some point it will pick up. Maybe until the next elections also nothing may happen. I mean, the next elections, considering how everything's are going, if the current mood prevails, if people remember, if you can understand what I mean, if people remember the second wave, then things can be tough. But people may not remember. You don't know how things work. We don't know. So, but you have to, if you are young and if your goals are far away, then this is the best time for you to accumulate. Don't worry about what the RBI has said. Just build a proper de-risking plan. I have this this seminar. This is the basics of portfolio construction, a guide for beginners. This link is available right in the description. You can click on that and start your journey in the right way. If you're already done it, if you've gone past this stage, good for you. But if you're just starting, then this is the right way to get oriented towards portfolio construction by considering the right factors. So catch you later. Bye bye.